Hi, everyone. My name is Phil Blancato, CEO and President of Lattimer Thalman Asset Management, Chief Market Strategist for Osaic. Welcome to another weekly Market Impact. You know, I love having guests on, and in just a few minutes, I'm going to have Dan Shaeffer join me from Cottonwood. And we're going to talk about the housing market. I get lots of questions about housing, so I'm excited to have Dan on. I'll let him talk to you about his background and who he is. And it's fun to bring experts on who could talk about something that's near and dear to all of us. You know, your own personal home, or maybe your kids trying to buy a home, grandkids, whatever, what's happened in the housing market and the real estate world in general. Cottonwood's an excellent firm that we partner with, so having Dan on will be fun. Quick update for me. I got to go down to Tampa, Florida for a couple days, and it's funny. The cold weather's following me. I get down there and it's in the 60s. Then I had to fly out to Arizona, and I was in Scottsdale yesterday, and it was 50 degrees there. I came back home to New Jersey, and yes, the snow is finally melting. If you could see outside, we still have plenty of white snow on the ground, but it's 37 and raining. So all that aside, it's all good. I am going skiing this weekend, so I'm moving the podcast on a Friday for once. You'll get it on Monday, but we're doing it ahead of time just because we want to make sure I can fit it in with Dan's schedule. Just for fun, Luca's coming home this weekend. College kid needs a break, so I'll get to pick up Luca from the airport in a couple hours. Exciting for her that she's very involved in Miracle. And she's been involved in Miracle, which is an organization that raises money for the Children's Specialized Hospital of Atlanta. And this year, being the senior member on the team after doing it for 4 years, she's out there fundraising and active, and she just needed a break. So I give her credit. She just does this to be a good person. Actually, Marcella does it too, my other daughter. But Luca's very much been the one spearheading it. So it's very exciting for her to get as she wraps up her college career, going out on a high note. But this weekend, coming home. And for my ski aficionados out there, you know, it's been ski season. The skiing has been great on the East Coast. For whatever reason, without the girls home, I don't go skiing as much. I have no one to ski with. But my brother goes on his own. I don't get to go with him as much. So I haven't gone skiing this year. Guess what I'm doing this weekend? I am going skiing finally. Looking very forward to finally getting out there and doing a little skiing. As you know, for all you who listen to this podcast, it's something we talk far too much about. I want to give a quick update on markets. I know this week has been a really volatile week. We see more of the same. A lot of sell-off in software stocks. The S&P only up about a half of 1%. After today, it's going to be a little bit better. But the big announcement of the week was some of the data points. First, we had PCE come out, and I can't not skip over that. PCE, personal consumption expenditure, is the most important gauge of the Federal Reserve. And why it is that the one that's updated on a very frequent basis, specifically meaning looking at a variety of data points, generally on 148 every single month as to what it really costs to live. And that number came in a slight bit hotter than expected. Now, it's not the end of the world because consumer spending is okay right now. So prices up modestly, but it wasn't a great number. It wasn't a bad number. What it didn't do was follow CPI. Remember, CPI was a much better number, the headline inflation number. So this one suggested that CPI number was probably much more about energy than reality, that reality of prices still being stuck in that around 3% inflation. So this data point on PCE is going to give the Fed the ammunition it wants to not cut rates. And there's a lot of anticipation of it. So today's PCE was a little disappointment that we don't see this continued trend down. That wasn't a terrible number. 2.8% on a headline is certainly not the end of the world. And when you think about what the Fed ultimately wants to be down at 2%, you're looking at right now, core PCE for the month was 0.3 and core year over year is 2.5. That's not a terrible number. And then the headline number for PCE, like I said, coming in a little bit hotter than expected, but not terrible up there at that 2.8% range. Now, interestingly, when you look at CPI in general, where it ended, I'm sorry, core CPI was 2.5, forgive me. Core PCE came in at 3%. Forgive me, I had that backwards. Whereas headline came in at 2.9 versus CPI that was at 2.5 and headline at 2.4. In other words, not enough of the mumbo jumbo. Basically, today's data on inflation was a little disappointing. We had hoped that it would be a little bit better. We saw the spending range and personal spending come in at an increase at 0.4 month over month, which is a solid number. We saw a lot of the number being front loaded in October and November. So the consumer certainly hanging in there. The bulk of the money spent in the month of December, though, was on housing and utilities. Interesting. Recreational activities and healthcare. What we didn't see is traditional goods like furnishings and automobiles. What does it mean? probably more of the same in this K-shaped economy of the wealthiest Americans spending the most and driving the U.S. economy higher is still very much happening. The other big headline announcement, well, there was two. We saw GDP come out for the fourth quarter, first estimate, disappointing. We thought that number was going to come in much hotter than it did come in at. We actually thought GDP for that fourth quarter was hopefully going to be something around maybe as much as 4%, and it just didn't come in that way. GDP came in weaker than expected, came in at 1.4%. That's disappointing. We had really hoped that that number was going to be a bit higher. And the reason why we need sustained GDP growth to validate the big tax cut that happened and to try and get us out of some of this debt that we're in, this massive amount of annual budget deficit that we just can't seem to get out of. It looks like GDP growth for 2025 will be 2.2%. Good number, much better than the original number we expected around 1.5 to 1.7, but nowhere near the 3.5 to 4 that we need. Now, will all this spending on infrastructure in the United States drive GDP higher? We think so. We think the growth of the United States will be substantively higher because of new factories and new stories about pharmaceutical companies and power companies, and all this spending drives GDP higher. But disappointingly, we didn't see enough of that in the fourth quarter. But the biggest announcement of the week clearly was the tariff announcement. And where we stand today is that the Supreme Court has repealed pretty much anything where the president didn't have the right to do it. Basically meaning using it almost as a political weapon against other countries, like he did with Canada, Mexico, to a degree with China, certainly Brazil. And it probably means around $178 billion in tariff revenue is going to have to be returned as of now. The president's slated to make a statement about this, but certainly this is a blow to his philosophy around how he could use tariffs as a leveraging point. It doesn't mean all of them get repealed. I think some of them will fall within the guidelines of the president's ability based on imbalances of prices, but that probably only means about a third of them. So what you're seeing today is the market's reaction is surprising to me that I would have thought small cap stocks would have done really well in an environment like this. And as of right now, when we're starting this, and I want to not waste too much time today, but I look at what the market's doing so far today, and oddly enough, large cap growth stocks are doing better than expected. And then surprisingly, small cap stocks, while doing okay, not as good as large growth, and even international stocks doing a bit better. What does it ultimately mean? A Costco, for example, which was suing the federal government over tariffs because of the price increases, will now be able to not back off of that. Whether it's passing it on to the consumer, absorbing it themselves, this changes the narrative. It does take away a weapon from the president. Now, will the president stand for this? I don't think so. There's some workarounds here that he's probably going to have to go down, or simply ask Congress, while they still have the majority, to pass on some of these tariffs back, and give him the power to do this. That's a prolonged process. I'm not sure he wins that. So, as much as I don't like to talk politics on this, it does to me politics are somewhat irrelevant to the grand scheme of economics. It does mean that today's announcement is interesting, and we're going to have to keep a close eye on it. It probably means, from a debt standpoint, the federal government may have to issue a couple $100 billion in new Treasury notes, which puts interest rates higher, not lower, because we have to pay back the money that was taken in. The biggest thing I'm worried about, if it stands as is, 70% of the bill, of the big tax bill that passed, would have been paid for by tariff revenue over the next 10 years. So we got a tax cut. Somehow you got to make up for that revenue. You make up for it in one of two ways. You grow the size of the U.S. economy so you get more tax revenue, even though you cut it, or you make up for it with additional revenue coming in. Ideally, with a combination of both, and now it looks like it's not the case. So for us, we didn't think the tariffs was a big issue. You can see markets haven't really reacted terribly to it since Liberation Day. We had a great year last year and having a good year this year. So surprisingly, markets were able to survive this and move on. Yet today's announcement, I does think, is a hit for the federal balance sheet and for the president's ability to use it as a leveraging stick. So really substantive announcement today that I had to take a few minutes to talk about. I'll continue to talk about it in the weeks to come. But for now, Dan, welcome to the podcast, buddy. Thank you for joining me today.
Hey, thanks for having me on. Happy to be here. Excited to be part of this for you.
Awesome. Tell us a little bit about your firm and a little bit about yourself. Well, first of all, where do you live? Well, what do you do for fun, family, kids, anything like that?
Yeah, so I live in Salt Lake City, Utah.
Oh, you're a skier.
I
Then you're getting snow right now. Good for
Yeah,
you.
well, finally, yeah,
Finally, yeah.
so it's been the worst snow year in recorded history for the West,
Wow.
and Alta ski area, which is kind of my home mountain, probably one of the
Great.
finest ski areas in the world.
Yeah.
is about 25 minutes from my house. I live very close to Alta. Normally has had about 300 inches this time of year, 300 to 400 inches. Usually they average 500 plus at the end of the season. We're sitting like at 120 or 130 inches or something.
Wow, it's that bad. Now, didn't you get a
It's
big snowfall this over the
we,
weekend?
we had a huge snowstorm. The very first big storm of the season hit this week, and Alta picked up almost 50 inches in 3 days. So it
Oh
was a
my God.
massive storm. It's not going to get us back to where we need to be, but it's a good start to help us at least not have a terrible drought this summer in the West. So fingers crossed. February stays wet, and March is super wet, and April's wet. But I think what happened is there was this massive air mass over the Arctic that moved the jet stream, and it dumped everything on you guys.
Yeah.
Like,
And I
like
didn't go
I
skiing
my
like a knucklehead. Like we don't have the mountains you do, but I still should have went, you dummy.
well, I have four kids. My two oldest kids live in New York City, and I have three grandbabies in the city as well. And it's been the worst winter ever for them. Like so much
Yes.
snow for you guys too. It's just been so cold and nothing's melted. It's been super unusual. And we've had it's most of the days here have been in the 40s and 50s. We've had the weirdest, warmest weather I've ever had in the wintertime. So it's like
No kidding.
everything's upside down this year.
Yeah, it's flipped. That's true. I mean, I work in New York City, and there's still mountains of black snow and ice everywhere. It just doesn't. It's finally starting to melt this week, but it's not been pretty in New York City.
Yeah, I've heard it's really gross. My wife and I have a place in New York City. We have a condo there because,
Okay.
having grandkids, you follow your grandkids around. That's what you do.
Yeah.
And but we decided to stay away in January and February. The weather's always too nasty and cold and windy anyway. So we're heading out. I have a grandbaby turning 1 next week, so we're finally going to be back in the city. Hopefully some of the black snow is melted. But I started my career actually as an accountant. I worked for Ernst& Young for a couple years, and then I went to business school. And after business school, I actually moved to New York. I was an investment banker at Morgan Stanley for a number of years in the 90s and early 2000s. And then in 2004, me and a good friend of mine started Cottonwood. And Cottonwood is a private owner operator of multifamily housing across the United States. We operate mostly in the Sun Belt. We've been in and out of a few other markets. We used to be in Boston. We're out of Boston. We have a big presence in Salt Lake City, in Texas, in Georgia, Tennessee, Florida, the Carolinas. Kind of the high growth, high demographic states is where we operate. We do everything up and down the capital stack in multifamily, but that's all we do is multifamily. And so we spend a lot of time, understanding and trying to understand what's happening in the housing market because it has major implications for our business and for our investors.
So that's a great jumping off point. Well, let's start. With what happened? I mean, we used to build 2.5 million homes a year for a long time. Then the number post 2008 seemed to drop dramatically. And obviously, multifamily. I'm like, where I live in New Jersey, it's everywhere. Multifamily has replaced the traditional housing market. How did we get here? How did things get so turned?
Yeah, I mean, that's a great question. Honestly, there was such a structural reform during the GFC, and so many single family home developers went out of business and got taken out of business. And the lending standards became much, much tighter. It became much harder for single family builders to build spec inventory. You had to be a large publicly traded housing company to be able to afford to do spec homes. All the small guys, all the mom and pops with a pickup truck that would do 3 or 4 homes a year, those guys just couldn't get capital anymore. The lending standards got really tight. And so you had really a decade or longer, really from 2010, 11, 12, all the way through COVID. There just weren't enough guys building stuff. There just wasn't enough stuff being built because it was too hard to get the capital to do it because I think the pain of the global financial crisis was still on all the lenders' minds, right? And we had such an oversupply and such a run up going into that those scars lasted a long time, and we have perennially underbuilt, at least in single family housing.
What are those
Multifamily
numbers?
is a little
I
different
looked at it. To me,
story.
it seems like we're not building around 1 million homes a year. Not enough, and about 1 million a year. What do you think the real number is? We've heard a variety of numbers there.
I mean, okay, it depends a little bit on how you view demographics. If things have changed a lot this year because of the immigration has basically gone to zero. But in
Mhm.
a normal environment where we have normal immigration, call it 500,000 to 1 million people a year coming in, we were anywhere between 1 and 2 million housing units short per year. And it
Wow.
piled up for almost a decade. And so we rolled into COVID with a massive gap. There wasn't enough housing available. There wasn't enough multifamily housing. There wasn't enough single family housing. And when COVID hit, it was this massive wake up call for everybody in the housing world. But I mean, we're still living the impacts of what happened 6 years ago when COVID
Yeah.
hit.
Yeah.
And because interest rates basically went to zero, everybody that could get a home figured out how to buy a home with very, very cheap money that could qualify. And it drove the price sky high. When that happened, rents also started rising. We had rent increases like I've never seen in my career in 2021, in 2020, 20, and 22. And typically in our business, we try to keep up with inflation. We're 5% rent growth year after year. And if you look at back over a 30 or 40-year period, it's pretty consistent, with the exception of post-COVID. You had 10 to 15% rent growth every single year. And I think everything was just rising so dramatically. But you know, then we started building a lot more multifamily. And so we had this massive wave of multifamily. And so everybody I talk to, I say, in your city, how many cranes were up in the air in 22, 23, 24? There was multifamily being built everywhere.
Yeah.
Today, you don't see the cranes. Like we've kind of gone through the delivery cycle in multifamily, and new developments are off almost 50% from where they were in 2022.
Wow, that much. Because I remember here
That
reading there
much.
was 700,000 units built in 2023, I want to say. It's been a little while. And
Yeah,
that,
that's
now
right.
it- and then now I assume it's down to three, if based on what you just said.
2023 was kind of the peak delivery. When you talk about built and delivered, it's a little bit different, but
Okay.
basically we had units delivered around 600, 650,000. This last year it was sub 500,000. It's going to be probably around 250,000 units a year for the next 5 years
Wow.
because I mean, we had massive inflation, so
Mhm.
cost of materials is way up and cost of money is way up. And now most deals for guys like us don't pencil. Now, we're not big developers. We do some development if it's in a location where we just can't build anyway. We can't buy anyway. It's something great. We'll build in, but it's like 10% of our business. But it impacts everybody because there was so much supply built over the last few years, and most of it got absorbed because we had so much immigration, we had so much job growth that we filled everything up. But just last year in 2025, things slowed down for apartments pretty dramatically because we were still finishing the deliveries. Like these are 2, 3, 4 year build cycles, and so we're on the tail end of all this stuff delivering. And so we kind of come into 26, and most of the deliveries have flushed out, but we're still trying to fill up everything that was built.
So
And
many
so it's,
questions
it's
to
been
come
a,
in.
it's been an interesting market for us, but there's a massive, if you look at buying a home, I was actually in Phoenix this week too. I was down there with some friends racing cars, and
Oh, I should have told you. I can't remember what I did that with you. That's
I
exciting.
would have invited you. There's a
Man.
new race car track down there. It's really fun called the Apex Club. Anyway, a little plug for those guys. But I was having dinner with my brother one night, and he has a son who's like early 30s, engineer, wife has a great job. They're renting a house I want to say they're in like Gilbert or Chandler. Like they're renting a house in a smaller new house in a subdivision, and a house literally identical to theirs came up for sale, like 5 houses down. And so they're running all the math on it, and they're like, if we bought this house, which we think is a really great deal, our monthly nut is going to be 1,500 more a month than we're paying now in rent.
Wow.
And that's everywhere across the country.
Yeah.
Like the average rental rate in our country is like, call it $1,900 a month. And that includes New York, LA, and all the smaller, cheaper markets. The average home payment today is $2,900. It's the widest spread we've ever had in our country between what it costs to own a home and what it costs to rent.
I've talked about the unaffordability crisis in the United States, and I've used that exact stat that the spread between how much you make and how much they cost is wider than it's ever been. But you've hit on so many things that, oh my gosh, we could do this for an hour. But
Oh, I mean, this is a topic that we could talk about until we both died and passed away
yeah.
because it's such a big problem in our country, and it's unfortunately it's going to become a very big political problem too.
Yeah, and then we're just not building enough homes, and the price is too high. So I don't know. Look at Boston now trying to do rent controls. New York City, the reason why Mandami won was because a one bedroom in New York City is $4,000. I mean, I thought
Right.
it's a lot of money. So let me ask you a question that I rattles around in my brain, and it's just my looking at some of the data and look even in Arizona and Denver. It seems to me that today there's not enough homes. Obviously, you nailed it. But at some point, when the boomers start to die off, because the amazing part about the boomer generation is they've made so much money, they want to live their lives in their homes. In fact, we've seen a trend where you probably seen this more than I have that older boomers are buying bigger homes so their grandkids can come stay with them. So that maybe some point when the boomer generation unfortunately isn't here anymore, does that bring a glut of homes back into the marketplace because they're being, that asset transfer from boomers to everybody else? What do you think that does when it kind of kicks in the next 5 years?
Yeah, that's a great question. It depends on what your view of demographics is. If you believe we're going to have 5 to 7 years of zero immigration in this country, we will end up having more home supply as the boomers basically start passing away and those homes become available because we are not starting families nearly as young. We are not
Mhm.
having kids at the same rate we were having them. And we had all this growth in the 2000s because we had immigration. And so without immigration, you're going to have a really hard time having GDP growth and you're not going to have enough homes. Now, I don't know. I think the shortage is so big. I don't think just the boomer thing solves it on its own. But I think if you're, you're an economist, you know this. Either home prices have to fall or rents have to rise because eventually that gap has to change. And I think what happened, my personal view, and I think a lot of people agree with this, in 2022, 90% of homeowners had mortgage rates that were sub like 3.5 or 4%.
Yeah.
And it's this whole lock-in effect. And because that happened, as we went into 23 and 24 and 25, rates went up. There was no inventory. Home prices should have fallen 10 or 15 or 20%
Right,
after
right.
the COVID boom, but they didn't because nobody was moving.
Yeah, and the rates are just too low. They're still just too low. There's still
They're too low.
mortgages
Yeah, I
are
mean,
still.
even today, I think it's something like even the 2026, like 75% of all mortgages are still under 5%. Like 40% of all mortgages are still under 3% or 3.5%. It's like
Yeah.
there's a massive lock-in effect. It's slowly thawing. So I think it created this temporary like log jam in the market, not enough supply being delivered to the for sale market, which keeps prices high because it's just a supply and demand metric. But at the same time, we're delivering all this multifamily. So people are like, well, I guess I just have to rent because I can't buy. And we're at an all-time low for people who can qualify. Typically we qualify 40 to 50% of our population can qualify for a mortgage. Right now we're sitting at like 29% of people who can even qualify for the
Yeah.
mortgage.
And you
Credit
would assume
scores are
that bank
bad, prices are
regulations would
high.
change, but we expected all these regulations to change and make the allow the banks to lend more, and that hasn't happened yet either, much to
No,
my
not at all.
surprise. So
Not at
then, what does
all.
multifamily fit into all this? And it's in a very tight housing market, not enough being built. It seemed like multifamily was coming to the rescue, but it is that it doesn't. I guess it's just not enough. Not enough to have that impact.
It's not enough. It may have felt like enough in 2025 when there was a bunch of new units being delivered. The problem is everybody building new units, they're at the top of the market. If you think of the average renter is not at the top of the market, the average renter needs a B class unit, a working class person. There's no new supply being built in the affordable price category. Everything new that's being delivered, the guys want 2,500 bucks for a new two-bedroom unit because it's in a nice part of town. It's a high-end unit. So there's a bit of a glut of high-end stuff, and still a massive shortage of the more affordable stuff.
Yeah,
And there's really no easy way to solve it. And I can tell you, rent control does the opposite of solving the problem.
it's going to make it worse, right?
It just makes it worse because then nobody builds, people take units out of the market. I mean, look, I'm a landowner in New York City. I own a condo there. I'm not excited about a 10% property tax increase being proposed. I
Mhm.
can handle it. But for, all of the multifamily units that are rent controlled that are already basically losing money because you've had rent freezes during the last few years and you've had massive inflation on cost, what do you think is going to happen to their P&L if a 10% tax increase goes through? All of those owners are going to just start handing the keys back to the lenders. So now these lenders are going to own all these affordable, stabilized housing units in New York City. It's going to create a massive time bomb that's going to go off in the city. It's already happening. It's already this massive problem. I get it. Mamdani stepped into a really difficult situation. I'm glad I'm not the mayor of New York City right now, right?
No, especially I was impressed by the Journal ran a great piece of this. I imagine you saw it. I think it's 1.8 million square feet. Is that number light of traditional type B, C buildings that were no longer rented after COVID have now been converted to apartments because of this massive shortage. But to your point, there's not enough apartments there, and if you raise the rent on these things or raise the real estate, raise the tax on them, then it's just going to make it even worse. Now, that means you might have a private credit issue or a private real estate issue because we know
For
the
sure.
explosion in debt in the private real estate space. How many of those Some of those companies are already seeing some distress. Just today, Blue Owl, it's a little bit different of a fund, but putting up gates around redemption. So suddenly, how much of leakage do we get because of this? And then maybe the bigger question is, what's the answer? Are we going to become a country of rent versus buy and more renters than buyers?
I mean, I kind of think that's the short-term answer. I mean, obviously, I'm in the rental business. I want to see rents grow. And because, we're kind of seeing our business stabilize from a rent standpoint, we had this massive run up and then it's flattened. We really haven't seen rents drop, but for us, it's mostly flattened across the board. Because the supply's, kind of coming to an end, the supply wave, as long as we have some kind of job growth, we're going to have rent growth. We're going to start seeing 3, 4% rent growth again. It's going to be a great time to be in the apartment business because I don't think you solve this problem easily. Trump's trying to get all these builders to build these new entry-level Trump homes. But is the government really going to give away subsidized loans for first-time home buyers? Like some taxpayer has to pay for that. Like there's no free lunch there.
Yeah.
And honestly, this is a much bigger discussion, but one of the reasons housing is so unaffordable is because it's controlled tightly at the local level. Like if somebody wanted to come in across the street from you and build 200 apartment units, your neighborhood likely would shut them down,
Yeah, they would. Yeah, they would. The zoning
right?
boards,
The
so
zoning
on.
boards, somebody in the municipality, and I mean, I'm pro housing, but I also want to see good housing development. The local communities are always going to restrict housing. They have for 50 years, and they've just made the problem much worse until either the federal government or the state forcing zoning edicts on cities where builders can come in and build more affordable housing, even if it's apartments. You're not going to see it get built. You're just not going to see enough development because it's too expensive right now for people like us to say, I want to build, I don't know what town in Jersey you live in, but if I wanted to build in Summit, New Jersey right now, where I lived in Summit for a little while,
I
it's
grew up in
incredibly
I grew up in Westfield, so I'm right next door.
okay. So it's incredibly difficult, one, to find a parcel of land big enough.
Yeah.
And if you find a parcel of land to get the cities to actually give you the density, because the land is so expensive, you need to have high density to make the land cost pay off. And then the cost of construction is very high. And in Summit, I probably could get pretty high rents. There'd probably be a lot of renters who'd love to live there. A lot of boomers want to sell their houses, but still stay in their communities. But because the zoning is so tight and the cost of getting through the zoning process is so tight, it makes it really impossible. One of the interesting markets for multifamily has been Los Angeles. Los
Really?
Angeles is one of the few markets where there wasn't a lot of new supply added because California made it virtually impossible to develop anything new. Because anytime you try to develop in California, you'd have all these environmental laws under CERC law, and you'd have to go through all these hoops to get development done. And so I was talking to a friend of mine who used to work at a large publicly traded REIT. It took them 8.5 years to get zoning approval on a project in West Los Angeles. And
Eight
it
and a half
cost
years.
8.5 years, 300 apartment units. They're only trying to build 300 apartment units. It cost them $12 million in impact fees and environmental studies before they could even break ground. 8.5 years. So what developers have patience and capital for an 8.5 year cycle? Nobody. You got to be the largest publicly traded guys, and even then you start losing patience.
Well, it's funny where I live in Nutley now. I still own a home in Westfield by my dad. But my dad passed and he gave me a home there. But where I live in Nutley, they have a struggle because on one hand, they don't want new building, but on the other hand, they're running out of money. Our property taxes are so
Right.
high that they need new revenue. Well, how do you get new revenue? Well, you need new housing. How do you get new housing? Well, you got to tear down a couple of homes and build a big multifamily. Well, the town doesn't like that. So
I
I,
know. I know.
and there's a cap on property taxes of 2%. So suddenly there's a tug of war going on between how do I find more revenue, but the people who live here don't want to hear about it. So you're absolutely right. You're caught in the middle of this. And we're seeing prices of homes in Nutley, New Jersey, which is a nice blue collar town. Anywhere average home price is about 500,000 bucks above the national average.
Right.
That's a big number. And a lot of people
That's a
can't
big
even
number. And at 6% interest rate, a typical person who lives there, a 30-year-old who's starting a family or a 35-year-old, they just can't buy. So they got to go somewhere where there's rentals. So I say we're in the business of providing high quality, clean, nice housing for people. But what we've seen, the average home buyer today, first time home buyer today, is 40 years old. I mean, how old were you when you bought your first house?
That's a good question. I was 31, 32, 32.
Okay, I was 25.
Yeah.
So 20 years ago, first time home buyers were 30 years old.
Yeah.
So now, I mean, we probably started our families younger. We probably had more kids. All this,
Right,
the
right.
demographics are changing for sure. So I don't want to fight that. But the problem is we've created this situation where we've made it uneconomic for people to have housing. So I think this young generation, they're not going to be like us, where you and I were like, hey, I want to build a house
Right.
for my
Your anchor
family. I
property.
want
I'm
to buy,
thinking,
I got to have my house. I'm going to build equity. I don't think my kids are even thinking about that. They're like, it's so unattainable. It's not even on their radar anymore. So the culture is changing, and I do worry about it. I know this is a you and I could talk about this forever. This is a policy discussion. This is a political discussion. This is an economic discussion. There's a lot happening here. But at the end of the day, we tell people, look, if you can't afford to buy a home, you got to live somewhere. And so that's going to drive apartment rents for the near term, but nobody can afford to build even in the apartment world. So development's way down. So you're going to have rents start rising again. And eventually, I believe this lock-in effect on single family homes will start to thaw out and you're going to see single family home prices fall.
that's why I agree with that. And I am a demographics maniac. I study them very closely. You're spot on about the immigration piece. And even if we just level off and don't shrink, was it 198 million homes in the United States or was it 116 million? What's the number again? Do you
No,
recall?
no, it's like it's I want to say it's like 116 million because you're
116.
like 300 million plus people, right? So
That's it.
yeah.
Yeah. So that number to me has to be much higher if you have 300 million people when you got a generation of kids that want, and if you can't find the homes to build, you can't build homes that are too expensive. You have no choice but to rent. How
Right.
much will this play into? I hate to say this, it's going to be almost like a have and a have not scenario because the folks who inherit a house because they got it from a boomer who passed away have that chance to own one versus the kid who never doesn't have that in their opportunity, doesn't have that family asset. Then suddenly they're never going to get a house, or it's going to make it that much more difficult. And you have this kind of legacy of permanently renting, which is not something I can even personally wrap my head around. That's not what we grew up thinking.
Yeah. I mean, we're kind of turning into Europe, right? We have
Mhm.
massive debt to GDP overhanging the country. Kids are now living at home or they're in high density rentals. I mean, that's kind of what has been in Europe for 30 or 40 years. Owning a home in some of these other markets has been much tougher. The problem, it's going to create a political problem, and I worry that politicians are going to use tools they don't understand, like rent control, like freezes, like all this stuff that's just going to make the problem worse. And it's not going to help that person you're talking about who's not inheriting money to get into their first home and raise their family in a home,
And
right?
then, I mean,
Whatever
the
their family
problem,
looks like it doesn't really matter. So now, like, I know my kids, like I was fortunate enough, I made enough money. My wife wanted to stay home and raise the kids. That was her choice. She wanted to do that. My kids today, that's not even a choice they can talk about. They both have to work if they want to make it happen. It's
yeah,
really, it's really complicated.
and that impacts the number of children that people have. In Europe, to your
Yeah,
point, my family over there, I have a lot of family in Italy, they don't have babies. And why? They can't afford them. Their
right.
effective real tax rate, when you think the VAT tax, real, all the other tax included, it's close to 70%.
Right.
So I jokingly say I'm a big fan of Italian soccer, but the reason why Italian soccer is terrible these days is because they don't have any babies in Italy to become soccer players. I
Right.
mean, and,
You got to
and,
import them in.
if you look at the American-born population, it's flat, and I think part of it is where, this idea of owning a home is becoming harder and harder and harder. And a place where I live in New Jersey, you see it evident every time there's a home for sale, there's a line of people outside. The prices get bid up at a time, even with rates, still being quite high. What do lower rates do for this market? Does it make it that much harder? Let's say we get the front end of the curve gets cut by, make it up, 1%, which I don't think it's going to happen, but half of 1%. Let's assume by next year we get half of 1%. Now, the size of our debt, to me, and you hit on this earlier, is a real problem. Today's announcement about tariffs taking away some
That's
revenue is a problem.
that's complicated, right? That's complicated
Makes
for the revenue picture.
the 10 years seems to be stuck at around 4.10, call it. But by the way, everybody, the 10 years the benchmark for mortgages. So if the 10-year US Treasury rate falls from 4.10 to maybe 3.75 and rates go down, we can get a 30-year mortgage at maybe 5.75 or 5.5. That's probably a long shot.
I mean, I don't think it moves the dial. I think, right? Not today. It's just not enough. It's just not enough. I mean, in my business, sure, the 10-year under 4%, more people want to transact on the institutional side. We get more
Yeah.
institutional guys coming in because we typically trade assets around, 5% yields. And so as the 10-year gets around 4, the total leverage, the total cash on cash returns start approaching 5. That makes a little more sense in the institutional world. But if you're a single family home buyer and right now your payment's going to be 2,900 bucks versus 1,900 in rent, maybe your payment's going to be 2,650
Yeah.
if rates fall 75 basis points. I mean, I know the government, put $300 billion into Fannie's hands to try to basically buy down MBS so you could lower the rate and get the spread a little tighter. But you're talking 25, maybe 35 basis points. It's just, or I should say 25.25%, right?
Yeah.
On a 1% mortgage.
It's
I
not
don't
enough.
think it's going to get people off the sidelines. That's my
Yeah.
opinion. So I think we need to figure out how to grow incomes. We need to figure out how to, create more housing, both multifamily and single family cheaper. And I think that only comes from changing zoning. So I think the feds and the states are going to have to be more active and more in the business of what the cities want. And not all of us are going to like it, right? I mean, that's just really what's going to happen, I think.
I think you're right. I would completely agree with you. So let's kind of put the pieces together. If for the folks, this podcast is about investing. How do you take advantage of a scenario where the average home buyer is older, more people are renting than buying, the rents are going higher. And your firm represents the tip of the spear on this. How do people take advantage of making money off the state of the current housing market?
Yeah, I mean, I think it's really hard to do it in single family housing. Um, I think if you're a builder and you want to make money building, the builders are selling properties today where they're buying down the mortgage rates. So they're basically giving a huge discount on the house and they're plowing it into, a 1 or 1.5% mortgage rate buy down so those people can afford the payments. I don't know if that's sustainable. The other way to play housing really is to play it where you're buying into rental housing. But if you're doing it one house at a time, that's really hard. When you buy complexes like us, you get way better economies of scale. And so I tell people, because I have a lot of people that come to me and say, "Hey, I know you're an apartment guy. I want to buy a duplex, and I want to manage it myself." And that's a very valid business for anybody to do. The problem is, if I want to go buy a 300 unit apartment complex and it's $100 million and we have the capital to do that, we're going to buy that around a 5% yield, all cash. When somebody wants to go buy a duplex, there's so many people that can buy a duplex,
Much
their
higher.
yield might only be 3%.
Yeah.
And so by the time you finance it, you're losing money on the duplex. It's really hard. And so your better bet is to find people who are in the institutional world who get higher yields when they buy the stuff. And then I think, we're on the front end of probably a new cycle forming in terms of like rent growth and reasonable development. I think the returns are going to be pretty good. And so we try to create a scenario where people can invest in the platform and we go deploy it at higher yields for people. I still have worries generally about housing. Like I think we have an affordability crisis. I don't think it's going away. I'm trying to make sure we're investing in places where the governments aren't going to do crazy rent control things that might hurt our own investors' ability to make money, really at the expense of the whole market because they don't understand it. Rent control's never worked. Every economist will tell you it's never worked. It's only created
Never worked.
shortages and
Yeah.
it's created more haves and have-nots. But some people think it's an economic solution. And a great case study is Minneapolis and St. Paul. 3 or 4 years ago, St. Paul passed really strict rent control measures. Minneapolis did not. And they've had their own all sorts of other political issues there I'm not going to get into. Development dried up overnight in St. Paul. And in Minneapolis, it kept booming and they kept creating housing and
Yeah.
Minneapolis became more affordable.
Yeah. And Minneapolis is
So,
a thriving, politics aside, thriving city.
right,
I mean, for
right.
sure.
It was a major political mistake that had real economic consequences for St. Paul. So,
So what
you
does
know,
Cottonwood do? If you all explain your format. So if folks want to be a part of this and want to earn money based on the rental income, how do you guys help them do that?
yeah, so we're a private company. We formed it as a real estate investment trust, but it's private. So somebody invests directly in Cottonwood. We take their money basically as part of our fund. So it's basically like buying shares in the fund. We then take that money and we deploy it and we put it to work in either new developments, but more likely we're buying high quality existing properties, in these Sun Belt states. And we manage all of our own properties. We have our own proprietary management teams. And our job is to make sure we keep them full, keep them clean. We have really two goals. We want to have a great experience for the tenants because they're our customers. If we have a great experience for them and we create a nice quality place for them to live, they'll keep paying the rent and we'll keep having returns we can give to our own shareholders in the fund. So that's our primary business. Our secondary business is we do provide 1031, which is a like-kind tax exchange. So if a client has a piece of real estate and they're selling it, they don't want to manage real estate anymore, they can effectively roll that tax gain into one of our separate funds. We call these DST funds, And then over time, those funds will roll into our flagship REIT. And so those are different ways people can play. And those are more for people who've been sitting on real estate for a long time or have
Yeah.
inherited real estate and don't want to be actively managed anymore. We basically try to take the management off their plates.
Are you
That's
doing
kind
it
of
more
that's our
for
business.
total return? Like you want to see your value go higher, or you doing it for income, or is it both?
I would say 70% income, 30% for additional return, right?
Mm.
So right now the investors are making about a 6% dividend on the shares they buy into, and we're hoping to deliver 8 to 10% total annualized return over a 5 to 7 year period. That's really the target. So a little bit of appreciation, more cash flow, some appreciation, hopefully over a nice cycle. You look back and say, hey, made like a 10, I made 10% IRR.
That's pretty cool. And for my
Yeah.
compliance people out there, I'm not recommending Cottonwood. I'm just telling you
Yeah,
what
for
they do.
sure. Sorry.
So
Sorry if that sounded
we
like a
don't get
pitch.
we don't guarantee those rates of returns. We hope to get 8 to 10. We hope to get 6, but nothing is a guarantee. So, but
Nothing's ever guaranteed,
in
not in
my
this country.
experiences, that's what real estate does. So then that's helpful. Dan, so I get the question a lot. How the housing market is a mess, and how does any of this get fixed? I know you hit on it a bunch of times. If you're gonna kind of a conclusionary statement, are we becoming Europe that people are just going to rent, or do you think there's the ability to maybe loosen bank regulations? Maybe we see rates come down a little bit, but job growth stays consistent, and we start to get some building. And what's the catalyst we need to see that's kind of go back to where if someone wants a home, they can buy one, or find maybe a rental property that's not so damn expensive they can't live there almost, or
Yeah.
what's the solution?
That's such a difficult answer to give you a single solution.
Yeah,
I don't think the government solves it, but I do think high quality job growth
yeah.
and income growth will cover a lot of sins effectively. That's going to happen. I do think long term rates are going to be lower in this country. They're going to have to be for us to effectively afford this massive debt overhang. If rates move down significantly over the next 2 or 3 years, it may take a recession to do that.
Or
That
AI. You could get a productivity boom in AI without inflation. That's possible.
You
I thought.
could, you could, and without, and I worry about job displacement. I
Yeah.
mean, because
Mhm.
if we have job creation, we have rent growth. Without jobs, it's hard to get rent growth in some cities. That's a whole different topic we could talk about. But I do believe economic growth, job creation, and then I'm pretty confident that home prices will start thawing out. Like we're just because of the lock-in, they've just been sitting there locked up. As inventory starts coming online, I think we're going to see home prices come down a little bit. I hate to say that because all of us that are homeowners, me included, you included, we don't like that because
Yeah.
that hurts our balance sheet, in the short to medium term. But I think you got to have job and economic growth, and you got to have a little interest rate help. Though I don't think 50 or 100 half a percent or 1% makes a difference. I think it's got to be 2 or 3% change in interest. That may not happen in the foreseeable future. If that doesn't happen, it really has to come down to prices falling.
But you hit on
And
something earlier that's very important to me from an economic standpoint, growth standpoint. You got to have babies. And, until we figure out immigration policy, my mom and dad were from Italy. I'm a first generation American. You want immigrants to come in to start families and have babies because, the folks who live here aren't doing that as much. And if you end up not doing that, you look like Europe with lots of debt and no growth, or Japan or
totally.
China. And so I think we're at an inflection point. And honestly, I think housing is the first real world example of how bad this can get if we don't get our hands around this and get our debt under control, have better and wage growth has been pretty good. It's been above the rate of inflation, but not substantive enough to buy a house. So we've got some things to fix here. Otherwise, we're going to look like the rest of the world, and that would be disappointing we don't. I don't think we're that kind of country. We can be better than what we are.
Yeah, think of the economic engine we have here. It's never paid anybody to short the United States, right? Our markets have always figured out a way to innovate and get through this. You're right. Immigration policy has to get fixed. We can't have zero immigration. That just doesn't work. That doesn't create the life that all of us want in terms of growing our businesses and growing our economy. I get it. It was kind of broken, and there's ways to fix it. I don't think we figured out how to fix it yet, but I think that probably is the one thing that really propels the economy to continue growing in a way that, eventually over time, maybe you see those curves come back through and you see affordability start to get better. I would say the last 3 or 4 years, rents have become more affordable. So incomes have actually risen faster in the last 5 years than rents have, kind of once we got through the COVID
Yeah.
spike. So things got unaffordable for everybody on housing and rents. They've become better because you've seen more supply. So the law of supply and demand has actually worked. We delivered more supply, rents became more affordable. And so if we can do that in housing, which I don't know how to do it today with the current zoning and the current laws in place, then we could do it. So maybe it is a federal, hey, we're gonna change zoning at the federal level to create more building. And it's going to change the way our cities look and feel, but it may reset the bar where people can actually start finding affordable housing again. Some of us just may not like it in our communities.
No, and I think you're just spot on right. But it has to happen. I mean, ultimately for society, it has to happen.
It
Two
has to
quick
happen.
questions. The big beautiful bill had a depreciation aspect of it, which we're very positive on. That the ability to build a new company and depreciate, or take that money right off your revenue line. It's a tax deduction. Does that affect you at all? Is there any benefit you see from if they're going to build a new data center in Tennessee Valley? Is a multifamily going to go up next door? Is there some of that, or is that they don't really connect today?
Not really connecting. There were some accelerated depreciation and some credits for affordable housing. We have a
Mhm.
small piece of our business that's affordable housing, which is really targeted at people who are making, 60% of the area median income. And there were some things there, but generally speaking, it didn't have much impact on the traditional commercial real estate business.
The second one. A lot of clients are worried about the impact of AI and all the money they've made. They've done 400 or 500% returns on Nvidia, whatever stock they own, and they don't want to give it back. What I've answered to them is diversify. And one of the things you can be in areas that are not affected by AI. I'm of the opinion that what you do for a living is completely unaffected by AI, and I can't see a correlation there. But I'd love to get your opinion. Does AI matter to you in one way or another?
I think it does matter, and I think it matters because as AI becomes integrated into systems and businesses, there will be some industries that have job losses. I don't
Okay.
know how much. I think the tech guys are projecting much bigger job losses than we'll actually recognize because they always do with new technologies. But it comes down to us having being in the right markets. So let me give you an example. Dallas, Texas has been growing like a weed for 40 years, and we've made a lot of money in Dallas, Texas. However, a lot of jobs in Dallas, Texas are middle management, white collar jobs. And so if you believe some of the AI tools may soften the job market for some of those or replace some of those jobs, you may not have the same kind of job growth in Dallas that you once had. And so you may be better off being invested in a market like, Chicago, that's got more of an industrial base where it's harder to replace employees in industrial companies and healthcare companies, or Nashville that has a big healthcare footprint. It may be harder to replace those jobs with AI than it is maybe more traditional, let's call it back office financial service kind of jobs. And so I don't think it's yet known which cities will be winners or losers, but I think as the next few years evolve, one of our jobs is to figure out which cities will be AI winners, which will be AI neutral, and which will be AI losers. And the ones we think will be AI losers, we need to sell our properties today in those markets because they just may struggle. Now, I don't think this is still apartments that people always need a home to live.
Yeah.
But if job growth is just not awesome, let's say, we own in Tampa, which is a great market, but Tampa has a lot of financial service companies.
Yeah.
So, financial service gets hit because there's all these new tools to support the financial service industry, and you don't need so much middle management. Maybe Tampa gets hurt. Maybe we should sell out of Tampa. I'm not saying anything bad about Tampa. Tampa's been an incredible market for us, but I'm just using it as an example. And I think over
Sure.
the next 2 or 3 years, it'll be clear to us what markets are more AI protected or neutral versus the ones that might get hit. So even in our business, which you would think would have no impact from AI because we're just renting apartments, everybody needs a place to live. There's still some movement with jobs that could happen. I think it's too early to know, but I think over the next year or two, I think we'll have a better sense for where it might develop and what the tools might look like. And I'm reacting a little bit to what's happened in the market the last couple of weeks. I mean, the market's acting as if AI is going to kill all jobs
Yeah.
and
Yeah.
kill all companies. And I think it's going to take longer than maybe people in the markets think it's going to take. But who
Well,
knows?
we're still in the camp that it's a tool, not a replacement agent. Will Salesforce or Adobe be eliminated because of this? I wouldn't be surprised if some of the things they do is heard. But there's a
Right.
long way to go between going into Chat GPT and asking it a create and amend a document to where you can do it on Adobe today. I mean, there's a runway here, and we'll see how
There's a
companies
runway.
evolve and adapt. I think there's always a pendulum moment here. I think the pendulum's going a little bit too far.
Yeah. And this could be big productivity booms for all of us on our businesses,
Yes,
right? And so
yes.
we can do more with less. But over time I mean, I have a young man who works for us. He's 30. He's brilliant and he's been with us for a decade. And I can send him to any city and he can tell me what all of the different competitive properties are doing and what we should pay for any property we're looking at. He's very, very good. And I said to him, in the era of AI, how do I replace you? because he came up building financial models just like a traditional analyst. And today, we can build 3 or 4 times as many financial models in a day as we used to be able to with the tools. And he said, honestly, you train somebody, you put them in the business, you have them sit on a leasing desk and lease units for a couple of months. You have them actually learn how to do maintenance and understand CapEx. So when a roof is getting replaced or a parking lot needs to get replaced, the guy's thinking about the economics on what that means for your deal and for your returns. You create them into much better operators than just financial guys that try to figure it out along the way. He's like, I actually think we create better, stronger people, and they use these tools to make themselves more effective. So he's kind of a believer, and he's a 30-year-old, a young guy who's kind of seeing the tools benefit his life in productivity ways.
I've asked this question a lot for people who use it today. Are you using the extra time saved to have a better life, or using the time saved to make more money or do more work? And I'm getting about a 50-50. Every time I ask this of audiences who are actively using it, it's about a split. So maybe that's the answer. Maybe that we end up with working smarter, making a little bit more money, driving wages a bit higher, but maybe still getting some free time back. Well, then that's a win. And I do
That's
think
a
the
win.
industry and the data centers, the data management, the governance, the compliance. There's plenty. It'll take some time. There'll be a lull of people being let go, and I think people being added. At least that to me, it's happened. That's what history has taught us. Every time we've been through this,
That's
hopefully it's the
right.
same again.
Hopefully
Well,
it's the
listen,
same.
it's been a pleasure to have you on. Any final thought? I'll give you one last right. Anything you want, a parting shot for people who are worried about all this stuff?
You know, we tend to be doomsdayers in our country and in the financial markets because maybe doomsday news sells a little better.
It
The
does.
truth the truth is, it's never paid me to be a doomsdayer. It's always paid me to be an optimist.
Me and you both.
And so I would say I'm optimistic that as Americans we can figure out this housing thing. I'm optimistic that my little corner of it, I can be a tiny little solution to create great places to live for people and continue making good returns for my shareholders. I also believe that we're going to figure these kind of problems out. We'll figure out how to adapt to AI. It's going to be lumpy and bumpy, and we're going to have a few bumps in the road. But, my dad, who passed away about 10 years ago, always told me, like, if you go around every day and you have your hands like this in the air, you're going to catch stuff if you're looking up. If you go down looking at the ground with a pessimistic attitude, nothing's ever going to fall in your hands because you're never going to catch anything. And so my view
Love
is
it.
we're optimistic. I feel like a new cycle for us is forming. We've kind of been through some really crazy times post COVID, and it's not going to look like the last cycles because it's never the same. But I think it's actually a decent time, and I think we as a country can figure this out. But it's going to take some hard work and some tough decisions.
I think that's a great way to put it. I love the optimistic attitude. That's who I am. For people who know me, I use silly. That's a great analogy. I use silly ones all the time, so I think that's powerful. All right, fun time. Do you have a shout out of the week for me? You don't have to, but if you have one, I'd love to hear who you think.
Okay, my shout out this week is to Alta, Utah for finally getting the 40 plus inches of snow we so desperately needed in these western mountains of ours. That's my shout out of the
I
week.
like that's another one. That's a good one. By the way, I love to ski. I'm sure you're much better than I am. I'll ski anything, but I'm sure you're better than I am. I love snowbird. Snowbird is one of my favorite mountains. I've only done Alto once. I love snowbird. It's probably my favorite mountain after right there with Jackson Hole and Big Sky. Other two other mountains I like a lot. But your area of the world is amazing. So we'll have to do
It's
that
amazing.
together one of these days.
Well, I would love to host you at Snowbird for a day. It's one of my
That'd be
favorite
fun.
places.
Or it's a great place. Or I'll be in Aspen in a couple of weeks and never been there. I'm going to Snowmass. I'm hoping that's gonna hopefully get
Aspen's
snow.
great. I mean, unfortunately, the whole West is kind of thin on snow, but
Yeah.
a couple weeks is good timing. I predict you'll have a little better snow than they've had. So
No, I hope so. Well, my shout of the week will be the women's hockey team. For there's something about perseverance. And actually, I'll do two this week. I'll do Michaela Schiflin, who Michaela to me, yeah, I know Simone Biles deserves all the accreditation. I don't think, and she's just a bigger, larger than life person, and she deserves it. She's the greatest gymnast of all time. But Michaela Shifton is the greatest skier of all time, in my opinion. The woman, if you watch what she's done in between Olympics, 108 wins on the World Cup circuit for skiing is unheard of. And then finally, she won that race by a second and a half. Now think about that. Every skier in that race is a world champion skier. And she beat him all by a second and a half.
amazing.
For someone who's failed a couple times in the Olympics, and that's silly when people give her a bad rap about that. I think she deserves a ton of credit. And then the women's American hockey team, the way they rallied, late goal in the third period to score the winner in overtime, Those girls are tough and they are good. But the rally they put on, it's just, it makes you so proud to be American. And I'm very proud of the Italians. I'll give the Italians a shout out this week too, that my mom and dad were from Italy, as I said, and they come in now third in the medal count. For a little country which doesn't have a lot of people that ski, they showed up and they put on great Olympics too. So good for them. Really good stuff. Danny, thank you for being on. I appreciate it. I'll see you in New York City for sure. And this today was great. I think the folks will really enjoy listening to this. Thank you very much, buddy.
You're welcome, my friend. Thanks for having me on today. See you soon.
Thanks, pal. See you soon.
All right, bye-bye.
Bye bye.